Gentlemen, welcome back to the channel. The dot plot is out and we have the latest details that you need to know. We did see an initial rally on this, gave a lot of that back, moving up a little bit right now. There's some good and bad in the dot plot. I'm going to give you my assessment of what this means. In fact, not a lot actually changed, which I think is a little shocking to some investors. As always, hit that like button, subscribe to the channel, and check out the link down below in the description of this video if you want to come join the trading community. As I just said, Fed projections imply an additional 50 basis points of rate cuts in 2025. So the Fed cut today by 25 basis points. They're projecting 2 more cuts. That brings you a total of about 3 cuts this year. And then again, the negative side, and maybe where some of the bears can rejoice in this, 25 basis points of cuts in 2026 and another 25 basis points in 2027. Okay, so less cuts than expected next year, but pretty well in line with the market's expectation for this year. And again, I think Powell's main message today is we're going to cut a couple times this year, but next year anything can happen in terms of how many cuts we get. The Fed also said today in their report that inflation has moved up and remains somewhat elevated. And the Fed did maintain the current pace of their balance sheet drawdown. And the U.S. rate futures price in about 69 basis points of cuts in 2025 after the Fed's statement. Little changed from before. Again, you're not getting a big change in 2025 estimates, but it's going to be those 2026 estimates that do take a little bit of that additional fall, okay? For December 9th, 2026, it actually hasn't updated, but the odds of, further additional cuts is going to fall. The markets were pricing in the federal funds rate between 2.75 and 3%. The Fed's dot plot says the federal funds rate will be 3.4% for the end of next year. Okay, so that's a little mismatched. Take a brief look at the Fed's dot plot. The expectations for GDP were revised up for 2025, 2026, and 2027. So the Fed's expecting stronger growth. The unemployment rate has remained the same at 4.5% for 2025. The Fed did lower the projected unemployment rate for 2026 and 2027. PCE inflation targets remained unchanged for this year at 3%. And then 3.1% for core. Next year, PCE was revised up from 2.4% to 2.6%. And same is true exactly with headline PCE for next year. Now, the federal funds rate, again, that's where a little bit of the disappointment is. Not as much of a rate cut path expected for next year as we just went over. Now, for the first time, we are getting 2028 dots here as well, with GDP expected at 1.8% in 2028, 4.2% unemployment by 2028, 2% inflation on both metrics, and 3.1% federal funds rate by 2028 as well. So the dot plot is pretty much in line with what the markets had expected in terms of cuts for this year. A little bit less on cuts for next year, but I think some of that is offset by better than expected GDP growth and a lower than expected unemployment rate. Basically, the Fed saying the economy is going to be a little bit stronger than we thought. Inflation is going to be a little bit trickier than we thought for next year, or at least there's a big question mark on that. But we're still going to be getting at least 4 cuts between now and 2026, the end of 2026. But there's a big question on that as well. Inflation comes in lower than expected, or economy weakens more than expected. That's going to mean more cuts, and Powell made that clear. Jerome Powell says that job gains have slowed and downside employment risks have risen. Jerome Powell also notes that GDP growth has slowed mainly due to weaker consumer spending. Powell says that payroll job gains have slowed significantly, reflecting lower immigration and lower participation. And Powell says that job gains are running below the break-even rate. So at this current pace, Powell is saying unemployment is rising and labor markets are weakening. Powell says a good part of the job slowing reflects labor force decline. Really, immigration. Jerome Powell says inflation for goods has picked up. Disinflation for services is continuing. Jerome Powell says beyond next year, most inflation expectation measures are consistent with the 2% goal. Jerome Powell says overall effects of tariffs on inflation remain to be seen. Powell says the risk of persistent inflation from tariffs needs to be managed and assessed. Jerome Powell says the base case is tariff impacts on inflation will be short-lived. So that's a really good thing to hear Powell say from a stock perspective. And Jerome Powell says we are well positioned to respond in a timely way. Basically, if there's a development, the Fed is in a good position either way to hold rates or to cut rates further. And Powell says individual forecasts are not a plan, that policy is not on a preset course, which is what I expected him to say. Powell says we welcomed a new committee member, which is Stephen Moran. He was actually the only one today to dissent from the Fed, opting for a 50 basis point cut versus a 25 basis point cut. Powell says committee united in pursuing dual mandate goals and strongly committed to independence of the Fed. And Powell says an increase in goods prices accounts for most of inflation increase this year. That is good, again, in relation to services, because services tend to be very sticky inflation. You know, when a company charges you, $30 to mow your lawn and they change that to 35, most of the time that doesn't fall. Or if your phone bill goes from 40 to 50, most of the time that's not going to come down. It kind of continues, right? Goods can very much fluctuate, and goods tend to be disinflationary because of capitalism, where services not as much. Powell says, I expect tariff-driven price increases to continue this year and next year. Powell says it's possible tariffs are a reason for some slowing in the labor market. Powell says labor market changes are mostly from immigration changes. And Powell says that both labor supply and demand have come down sharply. Powell says we can no longer say the labor market is solid. And Powell said there was no widespread support for a 50 basis point cut today. Stephen Moran, the guy that Trump appointed to fill was it Kashkari's spot or the Fed member that just left? He was the only one that wanted a 50 basis point cut. Even Waller and Bowman, some of the more dovish Fed officials, did not vote in favor of a 50 basis point cut today. Powell says we were right to wait. Powell says the change in the balance of risks suggests a need to move in the direction of neutral. And Powell says we don't feel the need to move quickly on rates, which is two-sided, right? Maybe that's not as good for the number of rate cuts, but that's a really good sign that the Fed is not concerned about substantial, further weakness in the economy, which is good for earnings, which is the most important thing for stocks. Powell said that you could think of today's cut as a risk management cut. Jerome Powell says we have a very different picture of risks to the labor market since the last Fed meeting, which was only back in June. So Powell says things have materially shifted since then, which does not sound great. And Powell says labor market is cooling off, tells you it's time to take that into account in policy. But Powell does say the risk of higher inflation is now less than they were in April. So that sounds good. And Powell says not all of what is happening in the labor market is due to immigration. There's a clear slowing in demand. Again, does not sound great. As I said before, not all rate cuts are good rate cuts. If the Fed is cutting rates because they see a problem coming, that's not a good rate cut. Now, I don't think we can draw that conclusion from today, but the Fed is saying, hey guys, there's a little bit of a problem out there. Now, if you've been a viewer of this channel for a while now, you know that the US economy does not just fall into a recession. That's not how things work. The economy is too large. Although it's theoretically possible we just stumble into a recession, it is highly improbable that that happens. You need a catalyst. You need an event. But what I think the Fed would really say behind closed doors is we are one big shock event away from slipping into a recession. Like, we're not there yet, but give us a catalyst. If the tariff situation trade embargo with China were to happen today, something like that, trade falls apart, we have a problem. So I think the Fed is saying, hey, on a risk management basis, we want to not be as restrictive because we are in a more vulnerable position. Not great for stocks, not the end of the world. It's not crisis time, but it's not time to be just, chill and nonchalant about the state of the labor market either. This is basically what the Fed is saying. And Jerome Powell says, I wouldn't say all of the job market slowing is from tariffs. Jerome Powell says, we see inflation rising this year as good prices rise from tariffs. Expect it to be a one-time rise. That's good. Jerome Powell says the case for there being a persistent inflation outbreak is now less. And Jerome Powell says our policy had been skewed towards inflation. And Jerome Powell says it's time to acknowledge the risks to the employment mandate have grown. So you can see the whole time during this presser with Powell, anytime Powell says that inflation risks are not as strong or one-time events, you're getting a pop in markets. And then every time Powell says, hey, job market has a problem, you're seeing a fall on this presser, which is pretty typical to what I've been talking about here on this channel for the last couple of days. Powell says more people at the margins are having a hard time finding jobs. Powell says if you start to see layoffs, that could quickly push up unemployment because hiring rate is low. That's one reason we think it's appropriate to shift policy focus towards a more balanced one. Again, that's basically Powell saying, hey guys, we're one big shock event away from a potential recession. Although, I agree with that. Like, if we get a shock event, like, this is not the time for a shock event. Question is, are we going to get a shock event? Shock events don't happen all the time. Like, if Trump doesn't understand the state of the economy and does something wild with trade or something, like, that could be a shock event, but it's really difficult to say if that's going to happen. Jerome Powell reiterates the labor market is not solid. Again, at the second he says that, you get two red candles on the Russell. And we're looking at the Russell here because we do have a trade on the Russell in the trading community. If you would like to come join that, check that link out down below in the description of this video. That trade actually up 192.5%, up $1,000 or so. Fed Powell says we have 10 of 19 policymakers who wrote down 2 or more cuts for the rest of this year. 10 saw less than that. So kind of a balanced mix. And Powell says to look at the projections through the lens of probabilities. Powell says there is no risk-free path with a two-sided risk. Okay, again, markets did not like that comment either. And Powell says that independence is deeply in our culture. Powell says that he don't think we'll get to a place where the Fed is making decisions based on political considerations. Powell says annual jobs revision was almost exactly what we expected. Powell says BLS is working hard to fix factors beyond just jobs revision. And Powell says we need higher response rates to have less volatile data. Powell says we don't know that a quarter-point cut will make a huge difference. Powell says labor market is softening, don't need it to soften more, and don't want it to. This is one of the biggest headlines here. Powell says markets are pricing in a rate path, though not blessing that path. Okay, he's basically saying the markets are pricing in this projection of 5-6 cuts between now and the end of 2026. He's saying that could happen, but he's not guaranteeing that. The fact that he's even saying that could happen, well, markets very much took that in a positive direction. That's what gave us the bounce from the low. I did exit my Powell trade. I bought 20 of these IWM 235 puts expiring tomorrow as a hedge because my portfolio is all long, didn't have any hedges. And, for 540, sold 10 of them for 680. Okay, these are the kind of things that we are doing in the trading community if you would like to join us. Okay, now that we have Jerome Powell's press conference out of the way, what do I think of this? What is the long story short version of this? Well, what I really get out of this is Powell saying, hey, we're going to take this thing meeting by meeting. We don't think inflation is going to be a lasting issue, but we don't know how persistent it will be. So some uncertainty there, but leaning bullish, in that respect, okay? Powell says, hey, labor markets have really weakened. Reading between the lines here, Powell says, we don't think we're going into a recession, but if we had a shock event, another big fallout with trade, we could be on the doorstep of a recession at that point. We don't want to, be in a position that is not helping to prevent that, okay? If we were to get a fallout of the economy or trade or, a risk catalyst, we don't want to be behind the ball, okay? We want to follow the ball here. That's what this is saying to me. Now, the projection of rate cuts for this year is perfect, okay? We got a rate cut today. We're expecting a rate cut October, a rate cut December, exactly what we were expecting. The estimates for 2026 from the Fed are way lower than markets were expecting. The markets were expecting 2 to 3 cuts next year, and the Fed said maybe 1 cut, okay? So that was a lot lower than expected. But again, it depends what happens with inflation. Like, that is not a set path. So basically what we got is the Fed is starting to ease policy. They're not expecting an recession, but they're mindful that there could be further weakness. As I've said before on this channel, all rate cuts are not equal. Okay, if the Fed is cutting rates because they're fearful of the economy, that is not a good thing. I don't think that is what is happening here. I think the Fed is trying to make it clear they're cutting rates because they don't want further weakness, which is a good thing. So all in all today, I think this was probably a pretty priced in Fed report. 2026, I think Wall Street is going to just put that in the rear view for the moment because things are subject to change when data comes out. So I don't think Wall Street's going to massively sell off stocks when we're expecting 2 more rate cuts this year and a question mark essentially for next year. I think this kind of green lights an end of the year rally as long as we don't go into a recession and as long as the economy is not so strong that we don't get any rate cuts, which that could become one of the risks for your risk on areas like small caps. Okay, so the Fed today was the big catalyst, but specifically for Tesla, there is news that you need to know. And let's get started with that. Nissan is closing its design centers in California and Sao Paulo and scaling back operations in London and Spain. The company announced today Nissan is on the edge of going bankrupt. Uber Freight has partnered with Tesla to introduce a semi-truck accelerator program. They say, quote, "This first of its kind buyers program is designed to make electric freight more affordable and accessible by addressing key adoption barriers. There will be subsidized price." It says here, fleets purchasing Tesla semis through the program will receive a subsidy on the purchase price. Predictable growth. Fleets will integrate their Tesla semis into Uber Freight's dedicated solutions for shippers for a predetermined period. This creates an opportunity for carriers to forecast revenue with confidence, while shippers gain consistent access to reliable, zero-emission capacity. Will optimize utilization. Uber Freight taps into its extensive freight network to match carriers with consistent, high-quality freight from our strong shipper base, helping ensure the adoption of these Tesla semis that stay fully utilized and carriers see dedicated, real, measurable returns from the start. A little after 3 years since Tesla has started vehicle deliveries in Israel, the company has just delivered its 30,000th car in the country. Waymo has announced that their autonomous fleet has driven a combined 96 million rider-only miles without a human driver as of June 2025. Locations include Los Angeles at 16.5 million miles, San Francisco at almost 30 million miles, Phoenix at 46.39 million miles, and Austin at 3.22 million miles. And also in pretty big news today, Tesla's FSD Supervised is officially launching today to the general public across Australia and New Zealand. All hardware for Model 3s and Model Ys now have access. Tesla is also looking to make FSD supervised available soon by the way of a subscription model for eligible vehicles for $139 a month. There is no timeline for Hardware 3 owners just yet. Tesla is reducing FSD strike forgiveness to 3.5 days. According to the Tesla owner's manual for update 2025.32, the forgiveness period for each autopilot or FSD strike has now been cut in half, reduced from a full 7 days down to 3.5 days. Elon Musk commented on Sawyer Merritt's video here, where Tesla China posted on Weibo a fan-made video of the Roadster. It's very well done. Elon Musk says the new Roadster is something special beyond a car. On Kalshi and other betting markets, there's only a 3% chance that the Roadster comes out this year. So that could be more of a next year project, or maybe even 2027 project if we know Tesla's timelines. And the US federal EV credit is officially gone 2 weeks from today. Despite the updated IRS language, Tesla is still telling people you need to take delivery by September 30th to take advantage of it. Elon Musk responded to one X user suggesting that Tesla could reach a $25 to $30 trillion market cap. Elon Musk says, absurdly difficult, but not impossible. Option activity, we have 84 different trades today from hedge funds and institutions, totaling $63.04 million with a positive order value of 57%. So definitely on the slow side today. You do have 256,000 shares that are being covered on, 2.89% short interest of free float, $34.25 billion sold short in Tesla. That is up quite a bit. Recently, it was as low as, $27 billion sold short, but the stock has went up a lot in recent days. You currently have 81.23 million shares sold short, with short-term loan at 21.25 million, which is up quite a bit in recent days. Let me know your thoughts on this down below in the comment section. Hit that like button as well as subscribe to the channel. Check out that link down below in the description of this video if you have not done so already. Have a great rest of your day, and I will see you in the next one.